How did bank runs cause the Great Depression? Imagine waking up one day to find that your bank is closed and your savings are gone. This was the reality for many during the Great Depression. Bank runs played a vital role in this economic disaster. A bank run happens when many people rush to withdraw their money at the same time. They fear the bank will fail and they will lose their savings. Banks do not keep all deposits on hand. They lend out most of the money, keeping only a small portion as reserves. When too many people try to withdraw their funds at once, banks cannot meet the demand. This leads to closures or forced sales of assets at a loss. The Great Depression began after the stock market crash of 1929. This crash exposed weaknesses in the economy and financial institutions. Panic quickly spread among depositors. Bank runs started in late 1930, beginning with Caldwell and Company in Tennessee. This triggered a domino effect, causing smaller banks across the Southeast to fail. One significant event was the collapse of the Bank of United States in New York City in December 1930. This event intensified fear nationwide and led to even more bank runs. As banks failed, depositors lost their savings. At that time, there was no deposit insurance to protect them. Throughout the 1930s, about 9,000 banks collapsed, wiping out approximately $7 billion in deposits. This devastation affected countless families and businesses. The loss of financial capital made it hard for businesses to get credit. As a result, industrial production fell sharply, and unemployment rates soared. The banking crisis also damaged public confidence in the financial system. People began to hoard cash instead of spending or investing. This behavior reduced demand for goods and services, worsening the economic situation. The Federal Reserve did not effectively intervene to stabilize the banking system, allowing panic to spread and deepen the downturn. Things started to improve when President Franklin D. Roosevelt declared a national banking holiday in 1933. This holiday temporarily closed all banks to stop runs, assess their financial health, and restore public trust. Following this, deposit insurance was established under the New Deal. This protected depositors and helped stabilize the banking system. Bank runs made the Great Depression worse by destroying banks, wiping out savings, and contracting credit. This eroded public confidence and intensified the economic decline. Understanding this sequence shows how fragile banking systems can amplify economic shocks. It also highlights why reforms like deposit insurance are essential for financial stability.